Let's talk about active versus passive management. Active management is where you or a portfolio manager or a mutual fund tries to pick investments that go up in value over time and avoid investments that go down in value over time. So let's use the stock market as an example here for passive versus active. In a stock portfolio, you're trying to pick winners, and then at time 0, you've picked these winners, or these stocks that you hope are winners, and at time 1, you change your mind and want to get rid of one and add another. So you're actively changing the portfolio. You're trying to pick the winners and get rid of the losers. And over time, of course, the portfolio makeup changes, and you can adjust to either put companies in or put companies out of the portfolio. That's active management. Passive management is buying the entire portfolio of all the potential companies in it. So a typical example is the S&P 500, which is the S&P 500 is the largest 500 companies in the United States, and a portfolio of those can easily be bought. They're very readily available, and you buy a little bit of all the 500 companies in the United States. Passive investing is holding that portfolio of all 500 companies and not changing it over time. So your passive investment would simply take the returns of all these 500 companies. Active investment would try to get rid of some of the companies in the S&P 500 index and put more money into the ones that they felt would go up in value. So passive investing gives you market returns, and active investing tries to beat market returns. So active investors or active managers, active portfolio managers, are trying to beat the market return, and the passive investor is trying to accept the market return. So the passive investor is lower risk, lower return. The market, the beating of the market, is higher risk and potentially higher return. In the statistics that have done in the studies is that most active managers do not beat the market. They, in fact, readily perform less than the market. So, but if you get one that beats the market, you get higher rewards. So this is higher return, higher risk. This is average return, average risk. So when you think about your investment strategy of active versus passive, you have to think to yourself, are you trying to beat the market, or are you just trying to gain the market returns? If you're trying to beat the market, it's going to be higher risk, higher potential rewards, although they're not guaranteed. And if you're trying to accept the market returns, it's less risk, but it's also less reward. So think of active management as trying to beat the market and passive management as accepting the market returns.